So, we talk a little bit about, the government, and the government obviously has these scandals. In the financial planning world, of course, one of the biggest government entities that seems to be propping things up is the Fed.
Right.
Talk a little bit about that.
Well, the Federal Reserve was started back in the 1900s, and it's actually started as a way to help finance World War I. And over the years, it has become the agency which controls the supply of money in the economy, and they do this by buying and selling bonds in the open market, which either puts cash in when they're buying or takes cash out when they're selling. So they can affect short-term interest rates. So they can affect the rate that Treasury bills trade at, and out to the 10-year bond, they can affect that rate by what they're doing. And recently, we've had, back in the 30s, there was an economic theory that said that when economies turn down, what a government should do is go out and spend a ton of money to stimulate the economy until it starts back up again. And it's called Keynesian Economics. We had a financial crisis in 2008, which basically was a deflationary crisis because we had asset values dropping dramatically. Most of our recessions in the past have been caused by high inflation. So it was necessary at that point to put money back in the economy. So what happened was the government went out and did a stimulus bill for $900 billion. Billion. The Fed ended up guaranteeing or loaning or putting out somewhere around $12 trillion into not only the United States but the world economy. We had a massive expansion of the food stamps program. We had a massive expansion of Social Security disability. And what ended up happening was that the Fed poured money in. Now, the Fed wasn't alone. The European Central Bank, the Bank of England, all of them were pouring money into their economies trying to keep the economy from collapsing. And the problem with deflation is this. We live in a fractional reserve economy. So if you put $1 in a bank, the bank keeps 25% of it on reserve and they lend out 75%. The theory being that not everybody's going to want all their money at the same time. The grease in that is money. If money doesn't flow, the system doesn't work. It has to have money. So the money dried up in an inflationary environment. And the reason it dries up is because when prices of assets drop, if you do nothing, the return on your money actually gets better because your purchasing power increases. So what happened in Japan, for example, was as prices kept coming down of real estate assets and other assets, people just sat on cash. And the cash bought more and more and more every year. And the economy kept getting slower and slower. So somehow you break that cycle. So what the Fed did was they started pouring money into the economy to get people to spend it. And they were buying up bonds, which lowered interest rates, which forced people out of bonds and safer environments into the stock market. It also gave people an opportunity to buy houses. So the housing market got stronger. And the economy started to pick back up because of what they call the wealth effect. Now, at some point, and this has been called qualitative easing, by the way, we're now in the fourth cycle of this. So what's happened? Okay, real estate prices are up generally. Okay, interest rates are down, way down. We have increasing activity in manufacturing companies. The stock market's way up. You think where it was in 2009, it was at 666, and now on the S&P, and now the S&P is at 1630.
It's up almost 3 times.
3 times, right, in basically 3 years, 3 or 4 years. The consumer is slowly crawling out of their hole, and that's important because they're 66% of the economy. The banks are no longer failing. Some of them are even propped up, but they're still operating. Tax receipts are actually running ahead of projections. Now, from recent experience, I can tell you they don't know where the taxes are all going either, but they're still there.
They don't know where they're coming from.
They're coming or going. The IRS is one of the, amazing. Anyway, labor mobility, which has largely been frozen for the last 4 years, is starting to pick up now because people can sell their house and to move to where the jobs are, where they haven't been able to do it before. And so it's caused these periods of pockets of unemployment like North Dakota with a 2% unemployment rate. That can't continue. So right now, the Fed has a problem. The economy's starting to pick back up, and their job is to come in and take the punch bowl away from the party without destroying the party. So how do you do that? Well, they're buying $85 billion.
Bring in a keg. You get
You
rid
bring
of
in
the punch,
a keg. Yeah, you
bring in
substitute the
keg.
punch for a keg,
Exactly.
right? Exactly. I almost, I chased some guy down on 520 the other day. He had 2 kegs of beer in the back of his car. I want to know where the party was. Anyway, the Fed's buying $85 billion worth of bonds every month, which is $85 billion in cash going into the market. But the government is only issuing right now $77 billion a month. So the supply of bonds is going down, which means interest rates could go lower. If interest rates go lower, the deflationary impact of the economy will be greater. So the Fed has to find a way to exit the strategy without destroying the economy. A similar situation happened in 1937 when the Fed tightened up and we went into the economy was recovering. We went back into a recession. So what the Fed's likely to do is just taper off, because if they stop immediately, there'll be a crisis in the economy. So they'll stop. They'll stop and go as they see. But this isn't going to happen fast. So if anybody's looking to have this in September, it's not going to happen. What's going to happen is that they'll phase this in over a number of years. They probably won't really start this until unemployment gets below 7%.
And they'll probably end it right at the end of the presidential term.
Yeah, somewhere along that.
Right.
So what happens is, and here's the other thing. Take this as gospel truth. Whatever they do, it's going to confuse the greatest number of people. Okay, that's sort of Gibbs' rule of the Fed. It will confuse everybody. So the question is, for folks out there, what do you do? Okay. Well, the first thing is, if you've been thinking about refinancing your house, I would start thinking. I'd get on the phone to Cobalt Mortgage, and I would get right down there and start refinancing. If you're thinking about buying a house, I'd get over to Skyline Brokers and talk to our friend here about buying a house, because these are good times to buy houses. Interest rates are low. You can get in. You can buy them. Yes, the market's hot, but you can do it. Don't make the mistake, however, of buying a principal residence and thinking it's an investment, because it's not going to be, never will be. If you want to do investments, buy something else. So when it's obvious that the Fed is slowing down, the stock market will take a correction of some sort, probably 5-10%, because that liquidity will be coming out of the system. People will make decisions based upon that. I don't know when that's going to be, but it's going to come. If you're holding bonds in a portfolio, you want to begin shortening the maturity of the bonds, because that will be less affected by higher interest rates, which will come when the Fed stops buying bonds. Be prepared. Volatility will increase in this environment. The ups and downs of the markets will get greater than they've been. We've gotten very lulled into these kind of slow, steady markets, but volatility will pick back up. And the place that will probably get squeezed the most will be the emerging markets, because they are dependent upon flows of cash from developed world and other places, which will stop as the economies of the developed world get better. That there will not be as much money to flow into other places. So those markets could get squeezed. So be very careful about taking investments into third world countries, especially some of the frontier countries. You're going to want to look back at the developed world, because that's where the growth is going to be. Sure. The other thing that'll happen is the dollar will get much, much stronger.
Well, it sounds like if you take a little bit of time to understand these things, as most people do, you take obviously a lot of time to do this, then you kind of have the ability to turn off the fear of the news and, again, get a little bit more passionate about what might be important to you, which may be retiring and putting your kids through school, buying that home, and I guess utilizing some of the happenings that are on the news or on TV that are meant to be fearful. And rather than taking them as, oh my goodness, the world is collapsing, the sky is falling, and we're all going to, drop into a hole, realize that, okay, those things are happening. Now, what can I control in order to make my future better?
Ben, I have not listened to a television newscast or a radio or, any kind of news show for about 8 years. I just don't watch them anymore. I'd much rather watch reruns of Friends than watch the news these days. I don't watch CNN. I don't watch CNN.
You like Jennifer Aniston in her late 20s, huh?
Who cares? Whatever. I typically am reading while they're on there. But anyway, I don't watch that stuff because I find it distracts me. I don't watch the financial news media because they're out there designed to get you to trade and make money, and that may not be in your best interest. The thing you got to do in a market like this is you got to set your goals. You got to decide what it is you really are trying to do. And if you're trying to retire in the next 5 years, you got to think about this. You got to think about how much money you're going to have. If you're getting started, you got to think about this too. Nobody is going to tell you how to do this. You have to do it yourself. There are people like me who can help you, but ultimately this is something you've got to make the decisions on. We're coming to a point where there's going to be a secular change in society. When the Fed stops doing this, things are going to change. You can go into it with your eyes closed and blame somebody else, or you can, as Shakespeare said, take arms against a sea of troubles.